please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point.
The Fed raised the GDP outlook, or the growth outlook, for next year a strong 0.4% to 2.5%.
This year's surprising softness in inflation primarily reflects transitory developments that are largely unrelated to broader economic conditions.
Hello, good morning and welcome to Power Breakfast in the Mumbai News Center. I am Anisha Jain and with me is Mangalam Malu. Well, Mangalam, good morning. Yesterday was a bit of volatile session for the Indian markets, but today there are cues galore for the markets. Now, in the US, we had, of course, the Fed decision coming in, 25 basis hike as far as the rate is concerned. Another important thing is that they have raised the forecast for GDP and they say that they are eyeing further hikes in 2018. Also, interestingly, the Senate as well as House have agreed on the tax plan as well. So, something that should boost sentiment. In the European markets, there's ECB meet today. There's Bank of England meet today. In Asia, we got the flash PMI numbers, manufacturing PMI data for Japan. That looked very good. Highest since 2014. For locally, we have the Indian markets WPI today, the Gujarat elections today. And do not forget, it is weekly options expiry. So, lots of cues to watch out for.
Absolutely, a lot of cues to watch out for. But the sea of green continues in the Asian markets. The SGX Nifty, after a volatile session yesterday, indicates a start. Look at the Asian markets. The only underperformer there is the Japanese index, and that's because of the slide that we saw in the dollar index after the Fed raised hikes. So that is why we're seeing some bit of weakness in the Japanese index. Remember, the macros are pretty strong. The manufacturing data that came by 54.6, the highest since February 2014. We had some moves come by on individual stocks, the likes of Toyota and Nissan as well. But other than that, all the other Asian markets, they're flying. And how? The Korean index up about 0.8%. Pull up the Straits as well as the Taiwanese index indices. Both of them should come off you, sitting with a gain of 0.7%. The Taiwanese index, the Straits, a tad bit underperformer out there. But the SGX Nifty, remember, after the sharp reversal that we saw from the highs of the day yesterday, the SGX Nifty believes or indicates that we can go up and open with a pop. It'll be very interesting to see, though, whether we sustain this pop or not, given the fact that our domestic cues will reign supreme, especially the likes of Gujarat elections.
Okay, so gap up opening for the Indian market is what the SGX suggests, but the US Federal Reserve followed through on an expected interest rate increase and raised their forecast for economic growth in 2018. The central bank has also projected for 3 hikes in the coming year. CNBC's Steve Leesman reports.
Federal Reserve raises interest rates 1/4 point to a new range of 1/4 to 1.5%. The Federal Reserve raising interest rates by 1/4 point to the new range of 1.25 to 1.5%. The vote was 8-2, with 2 regional Fed presidents dissenting, Charlie Evans and Neil Kashkari. The Fed forecast, however, further rate hikes ahead, saying it expects, quote, that economic conditions will evolve in a manner that will warrant gradual increases in the federal funds rate. The median forecast remains for 3 rate hikes next year, or a 2.13% Fed funds rate, 2.75 in 2019, and 3.06 in 2020. Those are both slight bumps for 19 and 20, but remaining on track with that forecast for 3 rate hikes next year. The Fed lowered the unemployment rate forecast to below 4%. I believe that's the first time the median has been below 4. 3.9 now expected for 2018 and 2019 for an unemployment rate. The Fed raised the GDP outlook, or the growth outlook, for next year a strong 0.4% to 2.5%. That means it would equal the expectation for this year, though no change in the long run rate of 2.1%. The inflation rate is still seen bumping up against 2% next year. The statement, speaking about the economic conditions, says the labor market has continued to strengthen. Economic activity has been rising at a solid rate. Job gains have been solid. The unemployment rate declined further. All of that very much the same language last time. Household spending expanding at a moderate rate. Growth in business fixed investment picking up in the recent quarter. On inflation, a little bit different language here. Originally, they said inflation had remained soft. Now they're saying it declined outright this year and is running below 2%. The hurricane, they say, has not and will not alter national economic activity. Finally, they say the committee expects labor market conditions to remain strong instead of strengthening somewhat further. So, guys, 8-2 on the vote, another quarter point, and expectations for another 3 rate hikes next year, and a little bit of increase in the outlook for growth and a little bit of decrease in the outlook for unemployment.
All right, let's also hear out what the outgoing Fed Chair Janet Yellen had to say on the policy stance as well as the inflation outlook going forward.
Our decision reflects our assessment that a gradual removal of monetary policy accommodation will sustain a strong labor market while fostering a return of inflation to 2%, consistent with the maximum employment and price stability objectives assigned to us by law. Even with a firming of economic growth and a stronger labor market, inflation has continued to run below the FOMC's 2% longer run objective. We continue to believe that this year's surprising softness in inflation primarily reflects transitory developments that are largely unrelated to broader economic conditions. As a result, we still expect inflation will move up and stabilize around 2% over the next couple of years. We still expect that the ongoing strength of the economy will warrant gradual increases in the federal funds rate. That expectation is based on our view that this rate remains somewhat below its neutral level. That is, the level that is neither expansionary nor contractionary and keeps the economy operating on an even keel. Because the neutral rate currently appears to be quite low by historical standards, the federal funds rate would not have to rise much further to get to a neutral policy stance.
Okay, Shane Oliver, the head of investment strategy as well as chief economist at AMP Capital Investors, joins us now on the phone line. Shane, good morning. Thank you so much for joining us. Well, big event coming actually from US with the Fed rate hike and GDP forecast also increasing for next year, as well as inflation is something that they have not changed. What is your initial reaction to that?
Well, there was no great surprise from the Fed raising interest rates. It was largely factored in. I was a little bit surprised that they weren't. They didn't actually revise up the number of interest rate hikes that they saw for next year. I thought that the so-called dot plot of Fed meeting participants' expectations for interest rates would go from 3 hikes next year up to 4, but in the event they left that at 4. And the overall statement and meeting itself was interpreted relatively dovishly by the market, which is why we've seen the US dollar decline. So I was a little bit surprised that they weren't a bit more upbeat about things. And they didn't signal more or a faster pace of interest rate hikes next year.
Right, Shane, you know, irrespective of what the Fed did indicate going forward, what is your sense of how the trajectory is likely to be given the fiscal policy would be looser? And do you expect the monetary policy to be slightly more tight going forward?
I think it will tighten going forward. This year has actually seen an easing in US monetary conditions, because even though we've seen 3 interest rate hikes, the fall in the value of the US dollar has actually offset that. But the reality is that the US unemployment rate is getting about as low as it ever gets, 4.1% next year. Even the Fed's got it going to 3.9%. I think the risk is it will go even lower still. And we've also got increasing signs that inflation pressure is building in the US. And so as a result, I think they will be forced to increase monetary policy or interest rates a bit faster next year. So we're looking for 4 hikes as opposed to 3. Is it going to cause a major problem globally? Probably not. I think those hikes will reflect strength in the US economy and the global economy will remain strong. But for investors, I think the Fed will be a source of volatility next year as they get a bit more aggressive in raising interest rates than they have been so far.
Okay, Shane, and what's your sense? What will be the impact on currency? You did mention that it might remain a bit volatile. So where do you see that heading in the near term?
Well, in the short term, we've seen a bit of a knee-jerk reaction overnight, probably also because the inflation number in the US, the core inflation rate, was lower than expected. So that explains why the US dollar's come down. But I think over time, the US dollar will resume its rising trend, and that we'll probably see emerging market currencies under some downwards pressure as we go through next year. Is it going to be sort of enough to cause a bit of a crisis like it did back in around 2015? There was worries about emerging market currencies falling. I don't think so, but I do think next year will be a little bit tougher for the emerging world as monetary policy in the US gets tighter and the US dollar goes up, and that creates periodic concerns about some sort of funding crisis in the emerging world. But for the moment, I mean, the reality is we're still in the sweet spot of the cycle. Good growth, good profit growth, and low inflation, low interest rates. So it's just a question of investors making the most of it.
So that looks good as far as your outlook is concerned, Shane. You know, so in that case, what does one do? Does an investor put all the money in the developed markets, put it in the emerging markets? Do you see money being pulled out of India, going into the US, or incremental money coming everywhere?
Well, I think there probably will be money coming everywhere into markets. Normally, towards in this phase of the cycle when investors are feeling more optimistic, a lot of that money goes into the emerging world, and that's what we've seen this year. But emerging market shares up to November anyway were up something like 34%. Asian shares up by a similar amount. So they've had a huge run, and that's taken emerging market shares generally from being cheapish to being slightly expensive, along with the US share markets. And I think next year there'll be a bit of a pause in that as investors start to fret, well, maybe the Fed is starting to get a bit more aggressive after all. It's perverse in a way. 2 years ago when the Fed first raised interest rates, investors got very nervous. You recall through late December 2015 and early last year in January, there was big worry the Fed will make a mistake. But now investors seem surprisingly relaxed about the Fed. But I think in an environment where the US economy is running very strong, that will start to use up spare capacity in the US, and therefore investors should be a little bit more wary than they are at the moment, I think.
Okay, Shane, thank you so much for joining us and putting that into perspective. But let's move on and talk about the US markets then. On Wall Street, the US markets ended higher with the Dow notching a record close. The S&P 500 ended mildly in the red, dragged lower by financials. Investors also digested news of congressional leaders reaching a tentative agreement on a tax overhaul plan.
All right, and in the currency space then, the dollar slides after the Fed Reserve raised its outlook for the US growth and held its forecast for the number of interest rate increases next year amid benign inflation.
And in the world of commodities, crude price is steady after falling 1% overnight.
From the precious metal space, then, gold prices spike on Federal Reserve hiking rates for the third time in 2017. The key overnight was the Fed hiking interest rates by 25 basis points. So to discuss that further, we're now joined by Seth R. Freeman, the CEO and Chief Investment Officer at EM Capital Management. Thanks a lot, Seth, for joining in first. First up, just wanted to know, what do you make of the Fed's decision yesterday? Are you surprised that they increased their growth outlook but kept the number of rate hikes unchanged for next year?
Not very surprised. Frankly, many of the words from Chair Yellen were very similar to the previous or prior announcement in terms of the economy performing well. I think the biggest difference is the outlook towards inflation and some concern going forward for what the impact of fiscal policy might be.
Okay, Seth, what is your sense? There are experts who are saying that despite the projections that are pointing at a hawkish tone, the overall statement coming in the press conference was a bit dovish. What's your sense?
Yeah, it was just kind of restrained, I would say. We're looking at a booming employment in relative terms, and they're looking for that to even become better. I think they were talking about 3.9%, but we are not seeing wage growth, and that's really helping constrain and delay the inflation targets that they're looking at. So it wasn't much of a surprise. I think looking at Asia already, and even looking at the Mexican peso in the afternoon, the idea of 3 rate increases at 25 basis points each, I guess you're right, it's fairly dovish and conservative.
All right, dovish and conservative said. So with regards to how things stack up right now from both the fiscal and the monetary policy perspective, and the fact that the equity markets are at yet another record high, what do you think is the trigger for further upside for the markets? And would you put more money to work right now?
Well, you know, I was even on a personal level looking at lightening up some of our equity holdings, and it does appear that because markets in Europe, Asia, the U.S. are pretty much in unison and strengthening, that I think this is good for equities. Equities are very forward-looking, and so I think that the continued records we've been seeing bodes well, at least for the next 6 to 9 months.
Okay, you talked about lightening your position in U.S. equities, but if that's the case, where are you putting that money now? Are you putting more in the Indian markets then?
Well, I think that there's still a huge opportunity in the Indian markets, as I have for 14 years now, and it's been well rewarded. India's going through some slowness, some lag period from demonetization, slow GST implementation, and so forth. But it's still very positive, and overall growth rates should be significantly higher than the U.S.
All right, that's positive news coming in for the Indian investors as well as the Indian markets, saying that the overall outlook for the Indian markets, despite the slowdown, is positive. Thanks a lot, Seth, so much for joining in and giving us that perspective.
Well, back home, it was a volatile day of trade on Dalal Street yesterday. The Nifty slipped below the 10,200 mark in the post-lunch session, and the Sensex gave up 0.5%. Now, the Bank Nifty underperformed, while sharp cuts were seen even in the mid-cap space. But to tell us the cues for today, Ekta joins us. Ekta, good morning. Tell us.
Hi, morning Anisha. Well, like you mentioned, yesterday we saw that downtick come into the markets in the second half of the trading session. So it seemed as though we were really unable to sustain our gains, to sustain our momentum ahead of multiple triggers that we have to reckon with, especially also the Gujarat election exit polls, plus the outcome itself, and not to mention the FOMC decision, which came out post markets yesterday for us. So just to put things into perspective, the Nifty all-time high stands at 10,490. So we're over 200 points away from that level, and we're closer towards the 100-day moving average of 10,086 currently. Now, like I mentioned, the big cue overnight was that the US Fed hiked rates as expected by 25 basis points, and it hiked its growth forecast. There were no real surprises which came in despite Yellen's last, press conference as the head of as the Fed chief. So there were no surprises. So the US markets ended at record highs, and Asia seems to be a little bit on the positive side right now. It's largely mixed, and maybe the SGX should come up for you to give you an indication in terms of how exactly we are probably going to start trade. Probably a little bit of a consolidatory note is what we are in, is what it's indicating at this point. Maybe a little bit of a bump up as well. Now, in terms of the other cues, mostly domestic is what we have to work with. So we have the Gujarat exit polls post-market to reckon with. We had the current account deficit, which was largely in line with expectations. So that came in at 1.2% of GDP. And it was actually a little better than some analysts' forecasts. So that was actually could probably work in our favor in terms of a positive. In talking about macros, we have the WPI for November, which comes out, and the street is expecting the WPI to harden to levels of around 4% with the core inflation hardening as well, and that's mainly following what exactly the CPI data did. So it would be fueled by fuel as well as food inflation hardening on a month-on-month basis. However, on the fringe macros such as the bond yields hardening, the CPI which hardened, the IIP which was lower than expectation, crude rising, and the fears of fiscal deficit not being met are all on the fringe and seem to be something that the markets will probably, continue to have a bit of a worry on. Now, watch for stock-specific and sector-specific action, because that seemed to have stood out yesterday. The likes of dairy stocks, paper stocks, select media stocks such as Sun TV, all of them stood out in yesterday's trading session. In terms of flows, FIIs as well as DIIs net sold in yesterday's trading session. Interesting cue coming in there, but the gross participation seemed to be lower than what we've seen generally, probably because of December. And there's an ECB meet today as well to watch out for.
But stocks, Ekta, what are the stocks on your radar?
Well, in terms of stocks, I will be watching out for, stocks such as Tata Communication, where the board has approved a proposal to demerge around 773 acres of surplus land. So that would be important to watch out for. M&M, where their subsidiary has basically executed a sale of 5% in CIE Automotive. MEP, where they've achieved a milestone for one of their projects in Gujarat in terms of 4-laning, so that's a positive. We have a couple of result reactions. Shimaru Entertainment, revenue was up 18%, so good performance coming in there. Profit up 26%. Everest Canto, where the revenue was down 18%, EBITDA was down 20%. Expect the stock to be under pressure. Pratap Snacks, good performance coming in, revenue up 10% for that company. So a couple of those stocks stand out. And besides that, we have a couple of other stocks such as Corporation Bank. RBI's put them under prompt corrective action. We also have Tata Steel, where they're going to consider fundraising. Max Healthcare, where they have responded to all of the cancellation of the license, etc. So they said that they filed an appeal against the cancellation of the license of Max Hospital, Shalimar Bagh, and Ruchi Soya would be in focus. They've also the company's been declared a willful defaulter by IDBI Bank. So these would be a couple of stocks to watch out for. And I'll wait for Lata to talk more about what happened with all of the companies with regards to the NCLT.